Hey guys and girls, it's Nathan here. Just checking out before we get started that everyone can hear. Just making sure that everyone can hear me clearly. If you can just send a message, that'd be awesome. Starting to see a few messages come through. Awesome. Thanks, guys. So first and foremost, thanks a lot for attending the webinar tonight. Obviously got lots of interesting things to cover. Obviously this one here is number 4 of my webinar. The last one will be coming up in the next 2 days. So make sure you tune in for that one. From housekeeping rules, just want to start off by saying I'm not your financial advisor. I'm not a mortgage broker. I'm not a finance strategist or anything along those lines. So on that front, just obviously always go and consult with independent financial advice and finance advice from that side of things to ensure that you're getting the right advice from whoever your people are that you use. If you do need help, I do obviously have financial advisors, mortgage brokers, and so on and so forth at this end. Today, I'm going to be covering probably the most important topic of this series, and that's to do with finance. Without finance, you can't, really move forward with investing or with investing in a property. It makes it a lot harder. Throughout the course of the last few webinars, just put a little recap there on the screen. I've been talking about lots of interesting things, a lot of weird things, a lot of things that you normally wouldn't see out there in the marketplace, you wouldn't see on the news, you wouldn't see from any of those areas. Today I'm going to be very normal and not go down those rabbit holes so much. However, if you feel that you've sort of missed out on some of that, email my office at admin@B.Invested.com.au and they'll be happy to send you over copies of the previous webinars so you can have a look at them and go from there. But in short, the finance market is changing, the financial market is changing. Everything out there is not what you're seeing out there in the media. A lot of people always ask me, obviously house prices are too expensive, all that sort of stuff. For me personally, I have about $20 million worth of debt. I actually checked the other day, it's a bit less than what I was thinking. It was about $17.5 million worth of debt that I've currently got. And for me to hold that sort of level of debt, I need to understand how everything works underneath it. It's very, very important for me to know what fundamentally changes certain markets, how markets move, and so on and so forth. And there's a convergence at the moment where, in 2008, 2009, we saw the GFC, which is a global financial crisis, which sort of affected the world. It was $7.5 trillion worth of derivatives or housing derivatives, CDOs, which caused basically the whole global economy to be put in a standstill, liquidity to come out of markets, and so on and so forth. Today, we currently have $1.2 quadrillion worth of derivatives out there in the marketplace. Some banks or financial institutions around the world, some of the biggest financial institutions, which I'm not talking about your standard banks that you would go to, I'm talking about large international banking systems, which have 75, $50 trillion worth of derivatives on their own books, and I see that is being a big risk to cause the GFC 2.0, which I'm coining as the GFD. And there's lots of things that are out of whack. A lot of people have asked me, how have you been able to predict interest rates 6 to 12 months out before they actually happen over the course of the last decade? And I take pride in that, and I always tell my the people that are close to me, that come to my events and stuff like that are in end of financial year, Christmas party, stuff like that, what my predictions of 12 months out will look like. And the only reason why I'm able to be able to do that is understanding the parameters of the finance market. And currently we're seeing the 10-year US Treasury bond rates increase very much. We're seeing the 90-day LIBOR rates increase, and this is going to be probably one of the triggers that causes the next GFC. But is it something to be fearful of? No, I quit my job at the age of 24 during the middle of the GFC, and I used financial instruments such as property and other instruments that were around at the time in order to be able to put myself in a position where I could tell my boss where to go at the age of 24. And I can see that there's a guy called Nick in here tonight that sent a message saying I told my boss where to go today. So awesome work. Just on today's agenda, I want to talk a bit about why finance is important. What do we need to know? How to prepare yourself for the next 12 to 24 months? The importance of being proactive. How the finance market's been changing. Looking at interest rates, whether they'll be going up or down or sideways or whatever. And sorry, I've got some ice in my mouth. And what will happen to the finance markets moving forward, and so on and so forth. So just getting into it. And why is finance so important? I've always said, you know, I can go out and find deals. Deals are what obviously I make money on when I go and buy a property. It increases in value. It gives me a cash flow attached to it. Improves my life in one way, shape, or form. And I always look at, you know, properties as a part of a jigsaw puzzle and how the actual properties fit in. It'll create the whole picture once you've got it. But it's important to understand, you know, most people go there blindsided. They don't understand, you know, how the properties are just going to buy a property, hold it, hope that it goes up, so on and so forth. Where I think it's important to understand what the end game needs to look like, have a goal of where we're heading to, have clear and clarity as to how you're actually going to be able to get there, and sort of work out and put the jigsaw parts into the equation in order to, you know, the properties are just a part of the jigsaw puzzle. However, what's, you know, a lot of people don't look at is that probably 50% of that comes down to financing, because without having the funds to buy the properties, you're sort of in the shit pile. And I think that's important, and sort of why I don't want to go too far down a lot of the other things that I've covered, because it's really important that we get this right and your financing strategy right in order for you to be able to take advantage of the sort of opportunities that are coming out there in the marketplace. Now, for me, if I didn't have constrictions with, if I wasn't constrained by if I wasn't constrained by, you know, financing, I'd be sitting here saying I've got 2,000 properties instead of 200. I made a call going back about 2.5 years ago when I was 30 that I was going to be a billionaire by the age of 40, and I'm still on track to do that. But obviously, with everything, there becomes hurdles and stresses and stuff like that. And probably the biggest issue that I've had over the years in building my own personal wealth is understanding how the finance works out there and making sure that you can, you know, position yourself correctly on that front. Currently in the market, lots of changes have happened over the course of the last 2 years. It started around September 2016. As global finance markets, we started seeing quantitative tightening rather than quantitative easing. Quantitative easing is what's brought all the money into the market over the course of the last decade. What we're seeing at the moment, we're going through a phase of quantitative tightening. So in essence, there's been a lot of money printed to save ourselves from going into a recession back in the GFC in 2008, 2009. And here in 2018, we're going through a phase where we're trying to unwind that, but something has to give. And, you know, there is a shaky time ahead. Looking, you know, I've got a few little notes here as well. Looking at any investment class, you know, finance is a crucial part to finance, because if you don't have the finance down pat, you know, it's very, very hard to do things. So if we look at who has finance in the world, it's not just investors. Most of us sit there and look at, we're property investors in our heads and just stuck at property investing, but most of the world's governments have finance attached to them. They're running in a surplus or a deficit. We heard the budget come out last week, and they talk about the surplus and deficit. They're getting deeper. If we look at most of the largest companies out there, you know, they're running on debt. I think from what I heard recently is that Uber is running at a loss. And you know, if you're going to go out for a big night in the city and you start using Uber a lot, and I live out from the city, what you'll find is Uber charges you a lot of money, but they're not actually making as much profits as you'd think, and a lot of them run from credit and finance and stuff like that. So finance is really underpinning not just a property investor's portfolio, because that's what most people look at. It actually underpins every part of economy. Your employer, if you're working for a large company out there on the stock exchange or whatever, they're probably most likely paying you using financing and liquidity from these sort of markets, as well as investors would. So I've just got a few little notes here. I've got lots of notes, lots of things I want to keep us on track with tonight. A lot of investors also, they don't understand where the crucial points are. Like, people might have a goal of getting properties, but if you don't structure it correctly, it can ultimately, cause you pain. So over the course of the last 24 months, we've seen APRA play a lot of tough rules out there. They've been put in the marketplace to obviously, I think APRA is doing what an interest rate hike would normally do to the market, but if an interest rate rise went into the marketplace, it would cause a lot of drama and probably kill most other markets out there, financial markets. So APRA has come in and tried and cool the property market without affecting, interest rates going up. Because if interest rates went up, it wouldn't just affect the property, it would affect everything out there in the system. And I think a lot of people don't realise how important that is. And from our side, I know from my clients particularly, a lot of them have been able to continue on buying and moving through this market because they're actually structured correctly, obviously using my finance strategist at Zinger Finance. But, a lot of people, what we've seen over the course of the last 5 years, 10 years, I've seen these ads that come out that says, you can buy a property for as little as X amount of dollars and you only have to go and reverse engineer that, and realize that they're talking about 5% deposits, 10% deposits. I think that probably like 98% of Zinger Finance's books is structured around, the 80% lends and 20% deposits, finding the right properties and attaching it to the right finance strategies, enables you to have a solid foundation, a solid core to work with. So, a lot of people will go out there and say, I want to have this property, I want to have that property, I want to do this. They focus so much on the property, but what they're leaving out is that if you acquire a property, what's that going to mean for the next step that you take? So what do I mean by that? If you bought your first 1 or 2 properties, you could say, I want to go buy a property in Sydney, for example. Sydney's gone up a lot, whatever the case may be, but the cash flow may not support the lending requirements. If the financing doesn't support, if the cash flow doesn't support the lending requirements, you could be able to purchase that property, but in turn, it means that you can't go back to the bank and service again for another loan. So, having a cash flow strategy with your purchases and acquisitions, having a equity and capital strategy with the acquisitions, it's very, very important to have a balanced portfolio to ensure that you can keep moving through any sort of property market cycle. And for myself, I've gone from buying houses in Sydney, buying units in Sydney, buying properties in metro sort of area, regional sort of areas, and also going interstate, buying high cash flow but very low LVR sort of properties like commercial properties, shopping centres, and all that sort of stuff. And each time I've gone to purchase the properties, I think to myself, what is this property going to do? How is it going to help me move forward and get closer to my end goal? And I think a lot of people don't question those sort of things. I'm in a phase at the moment where I wanted to, my portfolio is very established. I've got lots and lots of equity there. I've got lots of properties out there. I'm going through a phase in my portfolio at the moment where I'm probably more at a consolidation phase. I sold off a couple of properties 12, 18, 24 months ago, just because financing got tough for myself, and I got myself into a bit of a shit situation where I was trying to settle $10 million worth of property, and all my liquidity was stuck, and the banks had changed the servicing criteria, and then it put on a strain where I was chasing my tail for about 12 months. And cash flow is really important to factor in order for you to be able to overcome those hurdles. So I think it's really important for someone in the current market or wanting to take advantage of the upcoming market to really make sure that their finances are in check. What do you need to know? As I was saying, finance is tougher than what it was 12 to 24 months ago. I think as we go through 2018, 2019, we're going to see it get a hell of a lot tougher. Everything's under the spotlight. It's not what you're seeing just here in Australia on the news. We're seeing the Banking Royal Commission. We're seeing all the banks under the spotlight. The banks are starting to be perpetrated in the media as being Wolf of Wall Street style, like selling dodgy stuff and doing dodgy things. Yeah, I think that the underlying system that the banking system sits on, which is what I covered off in previous videos, is very volatile. It's sort of designed in a way for some to really take advantage of that, and some to have that take advantage of them. And if you don't get your finances in order, and you don't get your financial position in order at the moment, if we do see a GFD scenario, as I'm calling it, a global financial depression, I personally think the GFD will make the Great Depression look like the good old days. If you don't get your finances in order, I think that the doors are slowly closing, and I think that there's opportunity still there to be able to pull out equity to get yourself in good position. But if you're not taking advantage of that at the moment, by the time that you want to go and get your position fixed up, it may be a little bit too late from lending criteria for that. Because I do feel that we're seeing some things we just saw, for example, APRA come out and say that the investor cap of 10% lending. So banks weren't allowed to grow. For those of you that don't know, banks weren't allowed to grow their books by more than 10% growth per year to investors. So it's sort of really hammered in on investors. They're removing that cap, but there's a whole pile more underlying financial changes which will make it tougher. Most people go, wow, they're removing the 10% cap, but they're not looking at the fact that they're servicing on 7.5% interest rates or 7% interest rates plus principal and interest repayments and so on and so forth, which wasn't the case going back 12, 24 months ago. I believe that we're going to see prices be affected in regards to this. I'm already seeing prices be affected, which most people get scared and they go, you might have 10 properties and you go, I want to sell half my properties off and protect myself. But what you've got to question is, if you're selling off your properties, are you going to be able to go and repurchase those properties again? I feel that what we're seeing at the moment is a blip in the system. If you ask someone going in the Sydney market between 2003 and 2008, 2009 was a very, very shit market. Prices were going backwards or sideways. There was a lot of bank repos out there in the marketplace, so on and so forth. However, if you ask someone from that tough time back in 2008, 2009, are you happy you sold your house? Are you grateful that you sold your property? Whatever the case may be, they'll most likely turn around and say, no, I wish I had held on to it. So be very, very careful with your decisions, but make sure that you're sort of protecting yourself at the same time. In the current market, I'm feeling that first home buyers, the red carpet's being rolled out to them. That happened around the early part of 2017 to about the mid part of 2017, which is sort of why going back around the start of 2017, I did a lot of stuff around first home buyers because it was an opportunity to try and get them in the market so they can take advantage of the situations that were out there. There's lots of stimulus to first home buyers. There's lots of low interest rates for first home owners to get into the marketplace. The banks are still letting first home buyers use a 5% deposit plus capitalising the LMI, which that used to be a thing for investors as well, but all that stuff got removed. I think that it's important to look throughout these markets and look at the opportunity that's there, because I've done my forward research into the market. I've sort of prognosticated as to where we could be, what are the opportunities, what are the positions of where this market could go, which is what I've done for the last 15 years of being an active investor. And I can't see that the financial system as a whole being sustainable moving forward in the longer term. And I think that we're going to see a lot of stimulus come in. So a lot of people felt that 2008, 2009, the world was going to end. There was a lot of these statistical data type of people coming out saying, the house prices are going to move in a negative format to 40%. If they don't go down, I'll go and do a walk around Australia or whatever. They walked around Australia and they sold their house off and they lost out big time. And that's because the monetary system had changed a lot. And for us to get through the GFC, there was lots of stimulus. And what a lot of us need to remember is that if the financial markets died out there, what would happen is a much, much larger problem than any sort of property markets could ever bear into or fathom. So it's very important that the financial markets stay afloat, and I feel that getting through this phase where we're heading into will ultimately turn into a position where we're going to see a lot of stimulus, a lot of hyperinflation, potential for hyperinflation, and inevitably prices rising as debt costs become cheaper and cheaper. I think it's important, when anyone's buying properties or sort of building their portfolio, it's important to work out exactly what phase of your journey you're in. Are you in a education phase where you're starting out in your portfolio? Are you just getting your first property? Are you getting ready to buy properties and get your portfolio happening? Are you in a growth phase for your portfolio where you're accumulating properties rapidly? People say, how can you buy 10 sort of properties in 12 months or 10 properties in 2 years or whatever the case may be? It all comes down to ensuring that you've got the right properties and that you've got the right strategy and that you've got the finance sort of behind that. So I treat my property investing like a business. This weekend that's just gone past, I spent the whole weekend physically pulling apart my portfolio because I've gone through a bit of a consolidation phase. I'm working out how I can do certain things to push myself into the next position so I can do a lot more acquisitions and pick up some larger land developments and all that sort of stuff. So 3 phases, which is the starting out, the growth or the accumulation phase, and the consolidation phase. They all play crucial roles as to understanding where you're at and what are your goals and what should be your prime focus in those periods of time. So I'm just going to have a look here at some questions. I notice that there becomes a lot of questions in the webinar as well. I encourage everyone to ask questions along the way. After the webinar, maybe over the course of next week, what I will do is I'll answer the questions on videos and I'll start emailing them out and putting them onto YouTube just as a bit of a Q&A series to help everyone out get their head around things. How to invest in properties in 2018. I've talked about over the course of the last 10 years, building these portfolios of 10 properties, 15 properties, 20 properties, so on and so forth. People have said, that's impossible, you can't do it, you're stupid, it can't happen, it's a scam, or whatever the case may be. What I'd love to see is people going to ask these people, how their portfolios performed over that time, what they've learned, has there been any headaches, so on and so forth. And I think what you'd find is that things are never the same way as what you picture them to be. And when I speak to clients on a day-to-day basis, like I've got a group of clients that I look after and I call them up and help them build their portfolio and whatnot, and it's part of our buyer's agency service. Some people, when I speak to them, they go, oh, I just want to buy 1 property a year for the next 10 years. And so imagine if you bought 10 properties now, what could it be in 10 years time? Like you could be paying more for them, you could be paying less, so on and so forth. Some people don't realize what their potential is in order to build a portfolio. And some people have unrealistic expectations. It's like, I want to have 20 properties by Christmas, but you're not in a financial position to be able to do that. So, a lot of these people that we've built these large portfolios for with inside the business, they had an expectation at the start, hurdles come along the way. That is a part of buying a property, building a property portfolio, buying properties, is that inevitably you can't just set it on autopilot because everyone would be doing it. But the end result, what I do know is that I've got, I don't know how many clients, 100, 200, 500, 1,000, 2,000. I'd have to go and look through my notes as to who I've helped out over the years directly into, and I'd say it would be in the thousands. For them to be able to build their portfolios, I normally have like 3 or 4 meetings a week with clients just to have a portfolio review and so on and so forth. And I'm in a phase where a lot of people don't realize that they've just accumulated their properties over the course of the last 5 years, 10 years, the last decade. And they sit there, they're in a position where they can tell their boss where to go. They're in a position where they've got 15 properties, 20 properties, and all they need to do is tweak a couple of things, sell off a couple of properties, increase some cash flows, do a certain few tasks, and be able to, have passive income coming in of $250,000 a year or 100 grand a year or whatever the case may be. And, those portfolios, a lot can seem as a thing of the past. If someone was to go out and achieve that portfolio in 2018, it would be much, much harder. However, when I first started investing in a property, it was 2003. What I did find at that period of time is I couldn't get a loan. I was too young to get a loan, like it was 18, but I didn't have a credit history, all those sort of hurdles that had to come. But I was faced with low rents, high vacancy rates, interest rates were nearly double digits. There was a whole new set of dramas that occurred at that period of time. And it's important to navigate through every one of those property markets and those cycles in order to get the best result that you can. So necessarily having 10 properties in 12 months, 2 years, 3 years, 5 years sounds great, but does it need to be that? Because at the end of the day, it's not about how many properties you've got in your property portfolio. It's a matter of working out what the end result, what is that portfolio going to do and represent to you. So is it going to be a cash flow play? Is it going to be a capital play? So on and so forth. And in this current market, I'm still seeing some people being able to do that and build 5, 10, 15 properties in a period of 12, 24 months. However, it's important to understand the financing and buy in line with that. So, I started doing some projects where we buy land, build houses, so on and so forth, in turn to, help out some of those investors that have already built their portfolio, pay down their debts by making profits from chunk deals. So you could have a portfolio of buying one buy and hold a year, or two buy and hold a year, and then do one cash deal where you can, if you can make 200 grand on a property, you can use that profits to buy one cash or use it as a deposit, improve your serviceability, so on and so forth. I'm just having a look here. This is a market where you need to be more creative. This is a market where, when I say creative, you need to look at different opportunities. If I wanted to go and build the same portfolio that I built 15 years ago, I'd be shit out of luck because everything's gone up in value. So I need to, reassess, okay, what are the opportunities that I'm looking at? And there's certainly markets in Australia which I believe are undervalued and are positioned, like what I bought into going back in 2003, 2004. Those opportunities exist. I still buy them. I buy them for myself and for my clients and so on and so forth. Being creative, what I mean is more so, bulk deals, whether you buy a block of land, get the land cheap, build a house, build a duplex, sell one off, keep one, use that property from a cash flow perspective, from a capital perspective, and understanding what you need in your portfolio. Do you need a cash flow play at this point? Do you need an equity play? Do you need a capital play? The difference between a cash flow play and the three of them is, well, do you need a balanced portfolio as well? So some properties to look at which have a high cash flow, which may not give equity as quick. Some of them might have high equity, but crap cash flow. So that might be like a Sydney property versus a Queensland property. Some of them might have a strong cash flow and good growth potential and, an ability to pull out some equity. Some are just purely, you wouldn't want to hold that thing for too long. You want to buy it, build it, reno it, do whatever you need to do and offload it in order to pull in capital. And that capital could be positioned to, pay down debt or towards another deposit, etc. Just having a look here. I've got lots of questions coming in as well. Lots of questions coming through. Lots of questions. Keep them coming through. I'll try and get some of them a little bit later on, just depending on how we go for time. Just having a look here at my notes. Yeah, so looking at it, I feel that it's important to make sure, just on that last note, just closing off that, make sure that your finance is in line with your purchasing acquisition. Make sure that you have your bank manager, your mortgage broker, or so on and so forth, your team, your finance strategist, very, very close with you at all times to understand what is that next move. Where can we make the next move? How can we make that next move? And so on and so forth. Going back in the day, I never stuck to any bank for too long because I'd quickly outgrow them and move forward. There has been some banks that have been a little bit better over the years. There's been some banks that haven't been so good over the years. This is a time where I don't think that one bank could build someone a whole portfolio over a period of 5 years, 10 years, because of their servicing and lending criteria. So it's important to understand each bank has different lending criteria, different servicing requirements, and so on and so forth. And having a good sort of finance strategist that understands, your sort of blueprint as to where your portfolio is going to be, understanding your goals, and understanding which bank would lend specifically to your position. So it's important to have, that strong relationship for them. I think it's important more so now than ever to, budget, have your financial position in order, make sure that you're not bleeding and stuff like that, make sure that the house of cards is in order, and to also be finance ready at all times. Be finance ready, have capital at hand, have deposit ready, so on and so forth, and have room for financing. So understanding what your broker, finance strategist, whoever's doing your finance for you, have an understanding as to how you can use that finance or what your financing arrangements are going to look like. That could take 6 months to get your finances in order. I've seen, being exposed to the finance side of things very much so inside the business on an intimate level. I get to see a lot of the challenges that my finance strategists come along on a day-to-day basis. Sometimes people need to sell off their car to remove their car loan. Sometimes they need to pay off their car loan. There's lots of variables out there which will sort of inevitably sort of help out their position. So understanding your position, understanding what you can do to improve your position and put yourself closer to doing your next acquisition, because things are very, very different than what they have been in the past. There is also the opportunity that I'm seeing out there. A lot of people put deposits on properties going back 2 years ago, 12 months ago, where you might have off-the-plan units. I don't like off-the-plan units. I don't like buying stuff out of the glossy brochure and out of the glossy magazine. I like to try and make the opportunity. But would I walk away for something out of ego? No. I look at those opportunities like I've done over the course of the last 12, 14 years, hardcore really. I've done a lot of deals where there've been bank repos, a developer gone bust, a developer in financing trouble. And what I'm seeing out there at the moment is people put deposits down on a property going back 2 years ago, expecting that they're going to be able to be fine. And the finance market changed so much, or they may have had a baby, or they may have gone from self-employed, PAYG, like a normal employee, to a self-employed or a contractor. And they can't settle on the properties, the banks won't lend to them, they can't settle them, and there's people losing deposits, developers out there getting desperate because they need to meet their lending requirements and so on and so forth. So opportunities are arising out there in the marketplace, and I think if one is to be ready, I personally don't feel that this is going to be something that's going to last the next 5 years. We're 2 years into this finance market. People didn't realize 2 years ago or 18 months ago when it started to go where it is. It's getting tighter. We're probably going through the rough of the storm at the moment. But what comes after this? So if you can go through that cycle, be able to pick up what you can and being in a position, and any time with this financial uncertainty out there, there's always a room for opportunity and people to be able to capitalize on that market, because weak hands let money go out of them and strong hands pick that up. So being ready, understanding how finance works, being very close to your finance strategist obviously puts you in the best foot forward in order to take advantage of those opportunities as they arise. The importance of being proactive. As I said, like being finance ready is crucial for this. Being finance ready means, I see a lot of people out there with lazy equity. And it upsets me because I know for me to be able to build my portfolio, the biggest thing that I've always found is getting the finance. Like I could buy 10 properties or 20 properties at a time for myself personally, But you know, the financing's always been the thing. Like I've always staged my settlements, whether they're 6 months out, 12 months out, 24 months out, and sort of taken myself through those sort of markets. And what I see a lot of people do is they have lazy equity. You know, you may not have refinanced your property 12 months ago, 24 months ago, 3 years ago, so on and so forth. Getting the access to the equity. I don't have any slides tonight. Sometimes I have slides in these webinars and have lots of graphs and charts and stuff like that, which I think it would have been good if I had to put that in here. But basically, what's happening at the moment is the finance market's getting tough. It's going to get a hell of a lot tighter. So the doors are on fire. Everybody's running for the doors. People get trampled on the way out, so on and so forth. Make sure you're not that person that's going to get trampled on. But you know, in that process, if you're not accessing your capital, right? If you have equity in your property, even if it's like 10 grand, 20 grand, 30 grand, 50 grand, 100 grand, whatever, a lot of people sit there and say, I don't need it, so I'm not going to go touch it. But if prices step back, you know, 10%, that could knock out a chunk of your equity. If the market gets softer, that could, you know, play a role in you not being able to get your equity. If lending regulations get tighter, that means that you may not be able to get out your equity. If the market turns tough and you need access to liquidity and you haven't pulled it out, it's not going to be easy to get it out. It's going to be a hell of a lot harder to get that equity out or capital out. And you know, you'll probably be getting less capital out. If you had 30 grand attached, 30 grand equity out, sorry, and we're going through a rough sort of market and there's opportunities on the street, if you go to the bank and try and pull out your equity at that point, your properties, the banks may be a bit more conservative, and actually they may not be. They will be very, very conservative on what they're handing out as equity and stuff like that. So consider this as a bit of a pre-start to, you know, go out there and speak to whoever your finance person is in order to seek out whether you should be pulling out your equity. As I said, I'll make the disclaimer once again, I'm not your financial advisor, I'm not a financial advisor, I'm not a mortgage broker, I just understand property and talk about weird property stuff. So, but go and get access to it. Like the worst thing that I look at from a property perspective is, you know, if your equity is sitting in an offset account, you've got access to that liquidity. If you can't get access to the liquidity and you really need it, that 30 grand or 40 grand could be the difference between you being able to pick up the property 50 or 100 or 200 grand cheaper or below market value at that point. But if you don't have access to that capital or the cash flow or whatever, specifically capital in this example, you won't be able to take advantage of that opportunity. You'll be sitting there going, oh, I wish I had got this property when they were cheap. You know, I hear people talking about cryptocurrency. I wish I had bought this when it was cheaper. I wish that I had bought property back in 2008, 2009, but why didn't you, right? Is it because of lack of education, you weren't prepared, or whatever the case may be? This is a time to get prepared before the opportunities or as the opportunities coming out there and taking advantage of that. I'm just going to get some water. I'm still sick. I've been sick for a couple of weeks, guys. Been a bit crook. Yeah, and just finishing off on here, as I said, the glitches in the financial markets are where the opportunities are to be had. If you don't have your finances sorted, if you don't have a position to take advantage of those glitches, it's going to be, you know, not so pretty. It's not that it's not so pretty, it's just I get upset that I can't take advantage of things when they're on sale. And people might get annoyed with me or think that I'm being an asshole by trying to take advantage of, you know, a position where I can pick up something cheap. But, you know, have you been to a closing down sale beforehand and seen things heavily discounted? Have you bought, we're going into winter, if you go and find swimmers, they're going to be cheap at the moment. If you go and find a jumper 6 months ago, it's going to be cheap. Like, I'd rather be buying it and having it at a discounted price. If you don't have your credit card that day to take advantage of the sale, then you're going to kick yourself, oh shit, these jumpers have gone up from 20 bucks to 100 bucks. Lots of questions here. Cool. I've seen some questions come through, and I think I'm going to cover a few of these things. Cool. I'm seeing a lot of questions coming through here. I think I'm going to answer a few of your new questions that are coming through at the moment. So, why has finance gotten tougher in the last 24 months? Really, really important to understand how this works and why and how and what will change it. And I feel that, I've been gifted over the last 24 months to really understand through a brunt of my own settlements that I had to come up with and settle my own properties, to understand, and tie that back with my deep understanding of how currencies work globally, how the monetary system works globally, understanding how money gets printed. All I talk about on these things here is just my opinion, obviously, but opinions are based by experiences. I encourage you to go out there and do your own research as to how money operates, how money is made, how money is generated. A lot of people think the governments make the money. The governments don't make the money. These things called central banks, which are large institutions, make the money, and then they disperse it. The governments actually have to go and get loans from these entities, and there's thousands and thousands of different financial instruments that actually prop up the market. When you start seeing them implode on each other, that could mean a bad thing. If you see a lot of stimulus come in and a lot of money being created, it obviously has to flow out into certain markets. So at this point in time, we're going through a liquidity tightening phase of the market. Quantitative tightening is a scientific term that you would use. Quantitative tightening, we've had quantitative easing for the last 8 years. Whilst they're doing quantitative tightening, there's a lot of regulation that's coming in from the governments to the banks to actually impose laws to keep the bank safe. So the pain, I guess, that the market is feeling at the moment is sort of no different than the pain that the market was feeling back in 06, 08, 09, just before pre-GFC. The pain that was felt then was interest rates were rising. At this time, we can't move interest rates, so it's the ability to obtain the funds. That said, just in order to protect ourselves for when, for two things. One is to protect ourselves from having a collapse of a property market. I personally don't feel that we're going to see a collapse. A lot of people out there might say, oh, things are overpriced, we're going to have a correction. No, it all comes down to how the monetary policy works and how the financial instruments within that market work. Understanding that, that they're trying to protect the banks so they don't fall, but at the same time, the regulations are having a flow-on effect into the marketplace. Basically, from about the middle of 2017, early to mid 2017, looking backwards, investors were locked out of the market. There was an influx of first home buyers that were like, wow, we can finally get an opportunity, but now they're sort of drying out. And, this is going to bring us back to more of a stable sort of market, but the opportunity is going to be in, when people have over-expected, they've got emotional on deals, they've let the fundamentals of their core business go away, or whatever the case may be, where people get into financial positions or money troubles, and in essence, the opportunities, the bargains, the bank repos, whatever kick in. I don't think we're going to see as many sort of bank repos at this point in time because money is so cheap. So, I'm not so expected to see that, but more, people that are in a squeeze situational liquidity crisis sort of areas to be able to offload their properties cheap. And that's where, the opportunity lays. APRA's been a big play. They're just the ones that are controlling it. So APRA has come in to sort of govern the banks, to put pressure on the banks. And this isn't just an Australian thing. APRA is an Australian thing, but the banks globally have, they all sort of move interwound. The global financial markets are all interconnected. If somewhere has a tremor, it's going to flow onto every single market, and they're all sort of having a tremor. They're all sort of at a point where they're, getting a little bit shaky. So within saying that, I see there's a lot of opportunity from that because if there is ever a crisis, so what they do is they print more money, and money becomes cheaper. As money becomes cheaper, things get inflated because the dollar has less purchasing power. The dollar has lost, considerable amount of its purchasing power over the last, 10 years, not alone 20 years or 30 years or 40 years. Who remembers buying red frogs at school in the early 90s or mid 90s? You could buy a red frog 5 for 5 cents or whatever. You'd buy 5 in a bag for $2 now, and that's because the dollar is losing its value, and it will continue to do so. And debt becomes irrelevant with inflation because inflation is inflating that good away, and you can pay the debt off with tomorrow's dollar or tomorrow's purchasing ability. As I said, yeah, the government regulatory bodies are trying to keep the banks safe by sort of putting measures in place to protect us from this. So these things here have been writing on the wall for 2 years. What else has been happening? The 10% investor cap. Basically, if any of the major banks lend more than 10% to investors throughout a year, if their books grow by more than 10%, so say for instance there's $50 billion, these are just made up numbers that I'm making up now, if there's $50 billion of loans to investors in a certain bank, then that can't go more than $55 billion in the next calendar year. So that is being heavily scrutinized. That will be getting removed soon, but from that, what we haven't seen, what we're seeing in the news is that, but what we haven't seen is that the banks are now servicing on, you know, a high level of interest rate. They're calculating principal and interest in the equation to really be super conservative. And I think that that could also pose another landmine out there in time to come to cause the exact sort of cycles throughout this marketplace that we're heading into. Approvals are becoming much more stricter. They're looking at everything, your car loans, your personal loans, your credit cards, those store credits, all those sort of things are popping up that I'm seeing my finance guys actually having to deal with on a day-to-day basis. You know, one bank may reject something, but another bank won't reject it. So it's very important to pick the lender, understanding the position, and understanding that your finance strategist actually understands the nuts and bolts behind how each and every bank works, because that will play on as to whether you can service or not service, be able to continue building your portfolio, not build your portfolio, for you to be able to do that deal or not do that deal. A lot of people are having to go back and sort of remove their crap credit, so crap finance. So people say there's good debt and bad debt. I tend to agree. Some people say there's bad debt and there's worse debt. I think that debt for me, I'm just talking for myself and not as a financial advisor, I think debt for me attached with an asset that's being inflated into the future, for me that's good debt. Something not just attached to an asset, but attached to an asset and cash flow, because there's two variables with properties that I really like. I invest in all different financial instruments. I invest in property, crypto, precious metals, commodities, businesses, lots of different things that I invest into. However, the thing I really love about property, that's why I always talk about property out there without going too deep into sort of the other weirder things that I invest into, is that property is a needed resource or commodity, because we're a young country. We've got a lot of people moving into the country. There would be financial suicide for any government to stop, you know, migration at the level it is. We need to keep bringing people in so they'll go and work and go and pay their tax to keep our government in its financial position for itself. But we're a young country. We're a prosperous country. People like us and they see us as a safe sort of country. And you know, we're only about 220 years old. So given those fundamentals, we need more houses, more housing to supply to the market. So we're seeing prices strong. We see them go up in value as well. But we also see cash flow is strong, and cash flow also goes up in value via rent. So we've got two aspects which are fungible in a property, which can move upwards or downwards in certain markets if you don't buy the properties correctly. So yeah, a lot of people are cancelling their crap sort of credit for all those bad sort of, you know, types of purchases, whether it be the car or credit cards, whatever, they're removing that and getting that out so they can actually continue to buy properties. So they're some of the things that, you know, people can do, or the measures that people are doing out there in the marketplace in order to, you know, get ahead in the current finance market. They're taking a lot more when a bank is approving a loan. Basically what they're doing is taking scrutiny over every move that you make. I think there's a new law coming out, or a new measure to intertwine bills, so the banks can see which bills you've got which aren't paid on date or on time. If it goes down to that level, I know a lot of people leave their phone bill, their gas bill, their electricity bill sort of unpaid. May not pay it until it's overdue or whatever. It will show overdue bills and so on and so forth. And banks are sort of looking into those things more so now than what they ever have in the past, especially whilst being under the spotlight with all these royal commissions and all that sort of stuff. Banks are also being conservative on valuations. I'm seeing a large variance in valuations. So some banks are valuing up some certain properties much greater than what another bank would. So that's where I'm seeing the inconsistencies out there. It comes down to the comfort for lending on a specific profile of a person. It comes down to the comfort level of them lending on a specific property profile. And there's lots of fundamentals on that front. So some banks, I'm seeing the vals come in so much lower. I spoke to someone recently that's a valuer, and they're basically, the banks are saying value it lower to protect ourselves. So, that's why I'm seeing these cracks that are out there in the marketplace. So, take advantage of the time now, because it's only going to get tighter moving forward over the course of the next 24 months. So that's why, I'm doing this, is why I'm talking about it. I'll be doing other things this evening while doing this webinar. I'm just here sharing the knowledge so you can take advantage of these times we see, and to make sure that they're protected and taking advantage of the market as we see it. The other thing that we're seeing out there is banks are giving all these sort of bullshit excuses to sort of claw more collateral from a borrower. So what I mean by that is, instead of going in there and going, okay, I'm going to go and get here's a 20% deposit, the bank gives me 80%, I can go buy a property. In a lot of instances, the banks are saying, we don't like this client's risk profile. What we want to see is them do a 30% deposit and a 70% LVR, or we want to see the client put a principal and interest payment, so it obviously affects their weekly cash flow, so on and so forth. So these are sort of measures, lots of bullshit things that are happening in the back end. And I see it on a daily basis. Like my finance team is very, very knowledgeable and very experienced in these sort of lending environments. But the things that are coming from the lender's perspective are just getting crazier and crazier, and I don't see it changing anytime in the near future. Basically, trying to get more skin on the table. The question that I saw beforehand was about expats. Expat finance, people that have moved from Australia to Singapore or the US or Canada or wherever. Trying to get finance in Australia is almost impossible at this point in time to obtain finance. It's very, very difficult. And I've seen, probably, I don't know, maybe 10%, 15%. I've got a chunk of clients which actually do live overseas, like I buy for them and I help them with their portfolios. And over the course of the last, 12, 24 months, things have gotten a lot more tougher for the expats, because the banks are looking at them and saying, you're too much of a higher risk. What happens if your job isn't safe over there? What happens if this is the case? And their lending policies have changed in order to basically block those people from being able to fund a property or acquire a property. So these are all the little ways which the bank has sort of gotten tougher in the last 2 years. Lower LVRs everywhere. The application process is being declined more and more. I see more declines. People having to put more money in the table, more money in the deal. Every aspect of lending is getting tougher. Do I expect it to change? The media out there, the same place to bring you all your gossip, that tell you about the Kardashians, that tell you about how to get relationship advice from the Married at First Sight or whatever. They're the people that are telling you, finance is going to be good, it's going to change or whatever. It's just another knife in the side. So don't expect that it's just all going to be suddenly better come July the 1st when they remove the 10% investor cap, because there's other ways that have gotten a lot more tougher. But I do think we are sort of heading to that horizon where, it could be 12 months, it could be 24 months. away from great levels of stimulus coming through. And I think it will all sort of flow from when we see this event, which would be the GFD, which would be the implosion of the financial markets out there. So as I said, I'm not going to go into the GFD today. I'm going to talk about the monetary system into too far depth. Go and look at the previous videos if you haven't already. Structuring your acquisitions obviously accordingly to finance. It's very important to understand finance, understand the parameters of finance, more so than ever any time over the course of the last 10, 15, 20 years, because it's at probably the tightest level because money is so cheap. The money is coming out of the RBA is 150 basis points. I do expect that to change for a brief blip in the system, but and we'll talk about that shortly. But money is so cheap. It's the easiest, it's the best time to get money, but it's very difficult to obtain it. To appease the banks, I think it's important to understand what they're looking for, understand what is inside their risk appetite with each bank, and sort of position yourself accordingly with the acquisition. So no longer is it, I've just found this deal, let's go buy a property. It's more now, okay, what's the bank going to give me? How can I get the most leverage out of the bank? What would they take most likely, etc., from an asset perspective? So making sure that you're getting, do you need cash flow? Do you need capital? Do you need equity? Do you need a balance? What is it? And what is that sort of property going to look like so you can merge it with the right lending to obviously push through these sort of markets? Understand what you can do to make yourself look better for the banks. What do I mean by that? Going back was about 25. I went to a bank, and my position, it wasn't the best. I had 25 properties. Most people have one or two. Most people have two incomes. So I was on a single income, and when they go to the bank, they just say, I want to buy my first house. How can I help you? They go get a loan for 500,000 or whatever the case may be. And if you had my file or a first home buyer going to the bank would always want to take the first home buyer over my file because it's so complex and so much bigger and so on and so forth. So as an investor, you've already got that as a battle as you're coming to the bank. So what I was in a position of, I needed to get like, I don't know, 100 grand property here and a 50 grand property there, and just some very shitty little loans that I needed for some properties at this point in my life. And when I went to the bank, I'd actually printed out Excel spreadsheets of how all my cash flow sits, where my equity sits, the addresses of my property, what I purchased them for, what they're worth, the value of them, all of those sorts of things in an Excel spreadsheet. So when I actually gave it to the lender, they looked at it and were like, wow, this is like, I've never really seen something like this. You're a 25-year-old kid, you've got 25 properties, you've got X amount of equity, you've got X amount of cash flow there, you've bought it in like a business. So treating your investing like a business. Numbers do not lie. I've always said that numbers are the most crucial part to it. Emotion will lie. Emotion gets you killed. If you work on the numbers, they're the fundamentals that will teach you and help guide you to where to make a decision next. And being able to represent yourself to a lender, this is all my shit, this is where I'm at. What you've got to remember is the person at the other end of the internet or the end of the phone line or whoever's looking after your file at the other end could be on 50 grand a year, 100 grand a year, struggling to purchase their first home or the second home, or not understanding it. They see this file come across their desk and they're like, how come this person here is like this? They look at it and go, it's all too hard, we're going to decline it. But if they can have a clear picture and go, this is ticked, that's ticked, here's all the stuff, you being able to provide more information to the lender in a clear format, so they've got a clarity over it. They don't have to look at it and go, oh, this person's got a loan over here, a loan over there, it's too messy, move it on, we'll put another one in front of me. It helps you sort of position yourself better at the bank. That's personal experience, once again, not financial advice. I am talking about finance. All this is my personal opinions, views from personal experience as well. Yeah, I'm seeing a lot of questions coming through. I'll just answer one of them now. When the GFD happens, how quickly we will fall into it, and how long we're looking for it to play out. I think the GFD is going to be much quicker. It's going to be a short deflationary period, and I think we're probably, we're well and truly into the early stages of it now. It will come quick, it will come severe, and I think it's when there's a few things that could cause it. It could be the derivative markets imploding. It could be the stock market, something falling over there. It could be commodity prices increasing. It could be that the contracts on derivatives start triggering each other. It could be the yield curve. We're going to a cut formation at the moment with the LIBOR rate, which is pushing up very closely with the 10-year Treasury bonds. If that happens, liquidity will quickly get sucked out, and they have to amend that. So I don't know exactly what's going to trigger it. I do have my top 5 things, and that's where I touched on it there as to what would trigger it or what will most likely trigger it. I would be very surprised, given the fact that we're at the moment. The only reason why certain markets are where we're at the moment is due to the level of manipulation of the monetary system that we've seen over the course of the last decade. If all goes to where I see it playing out, I called March to May this year for where the cracks are definitely going to show. Here we are in May. Cracks are very, very visible in the marketplace out there. When I first started talking about it 12 months ago, about a possibility of a hyperinflation, the hyperinflation is the exciting part, right? That's at the end. Hyperinflation will make most people go broke, but if you've educated, you know how financial instruments work, you could also be in a position where you can take advantage of the market and things will be inflated, and whatever you're holding will be inflated in value. I personally think that if the level of manipulation keeps up, it could be kicked down the road further, but I think it's too late for that. I don't see us surviving past November 2018. That's my call. I'm saying it on video. I'm not one of those doomsayers out there. I'm just saying it as fact from what I see. So yeah, from that perspective, I think we're right on the eve. It could be any day. I spend 20 hours a day awake throughout the week. Weekends I normally just sleep because I'm also tired of lots of things that I do. But I try and watch every single market out there to understand the fundamentals and what's specifically moving. And I've made those calls many, many times over. So looking at the next slide, the question is, will interest rates go up or down? Basically, kind of upset that I didn't put the slide in, but I've already put it in previous videos. My personal view is interest rates have no reason to go up. We've been on 20 months, heading into the 21st month next month, which will most likely be an on hold. However, given that's the first time in history that it's been so long unchanged, as well as the fact that we're actually at the lowest interest rate that we've ever seen. So putting those things together, most people are like, oh, they're going to go up to 10%. They've always been here. If you pull out a chart and go to the RBA website, use Google, there's a good tool to go and find stuff. Be very careful where you get information from, because there's a lot of shit out there on the internet. I know every time I get sick, I go on Google, what's wrong with me? I've got the common cold, and it always ends up in I'm terminally ill and I've got a few weeks left. And that is what Google will give you, is certain information. It's important to understand what financial information to look at and what things are happening out in the market and where to actually specifically look. And if we're looking at the if we're looking for charts and whatnot, go and look at the 30-day, the 90-day interbank cash rate changes, and that'll give you an indication of where the yield curve is. If you go and look at where the interest rates have been over the course of the last 30 years or 40 years, you'll see that from the mid-1980s, basically every monetary system in history, I will touch on the monetary system briefly here, every fiat currency that's ever existed in Earth has eventually died and gone to zero due to a hyperinflation. The first hyperinflation occurred in the year 1024 in China, and the average lifespan of a fiat currency is generally 42 to 45 years. Our dollar that we see in place at the moment has only existed since 1971. The President Nixon had removed the Bretton Woods system that we were using for money beforehand. Between 1933 and 1971, there was a gold standard which underlaid it. Before that, you could actually physically go in and, I'll take a step back from that. People say when the US gets sick, Australia catches the cold, or whatever the case may be. That's the same for every country in the world, because every currency is pegged to a US dollar, and that changed in 1971 when we went from Austrian economics to Keynesian economics. And in essence, since 1971, we've seen money devalue and buy less and less. We've seen a lot more inflation, and the actual dollar die in its value of what you can actually purchase from that side of things. If you pull up interest rates from the US and pull them up from Australia, they are slightly different. And if you notice, in the last few years, all interest rates have been pegged down at almost $0, at 0%. But since the 1970s and the 1980s, we've seen a sharp decline as to where the interest rates have gone. So every recession that we see just before the recession, interest rates go up, and then they have to come all the way back down. I personally feel at this time, and I made the call to my investors, my clients in our VIP Christmas party 2017, that I would expect to see 1 or 2 25 basis point, which is 1/4% increase at the RBA level in the second half of 2018, and I think we're perfectly on track to that. Does that mean the interest rates are going up? I think they possibly could, which they shouldn't move up, and I think that policy changes out there has really affected and been able to keep the interest rates low, obviously APRA and so on and so forth. And this is the first time in history we're really in uncharted waters due to the level of stimuluses that have happened out there in the marketplaces and so on and so forth. If you look at countries like Sweden's on negative interest rates. Negative interest rates mean that, I haven't seen negative interest rates myself, so bear with me on that front, but they're negative, right? So imagine the RBA rates being minus 0.5%, right? That's unsustainable, right? You try and move it, everyone's so stuck to this cheap interest rate, it's like heroin in the arm. You're stuck on it, you're gonna have withdrawals, and it's not gonna function. And that's where the finance markets are at the moment. And I feel that we're in the days where we're leading up to a hyperinflation, because the next cycle of this monetary system that we've got will need to come with a lot of stimulus, like the stimulus that's been created over the course of the last decade. We saw what caused, as I said beforehand, what caused the GFC was $7.5 to $8 trillion worth of bullshit derivatives, which is just, bets against. It's a home loan product that's been packaged up. It happened in the US, but from the ramifications of us fixing up those issues, we've seen large financial institutions go bust. We've seen bail-ins go in, stimulus come from all different angles, as well as the total debt in the world heading into the tens of trillions of dollars. So, all this money's just been made up and is now floating around. They're trying to take that out. We're at a point where the dollar, I believe, throughout the next cycle will die. And that's a big call to make, but it's a 5 to 10 year thing. You're starting to see the cracks out there every day of the week, and some of the things you'll see on the news, some of the things you won't see on the news, and you have to go and read sort of financial sort of markets and understand where things are moving to sort of keep your heartbeat moving with those sort of markets. So, but in the long term, where do I personally see it? As I said, none of this stuff tonight is financial advice. It's just a personal opinion. It's just my own view, so do not take it as any financial advice. Go and seek your own financial advice and get your own finance strategists and so forth. But for my projections, for what I've projected for myself, I see interest rates heading up possibly by 2/4%. The banks moving them independently anyway. Interest rates may move up another 2/4%, so maybe in a total of 1% increase in interest rates at the RBA level, but inevitably it's not going to be sustainable at that point, and I see them coming down to 0 in the longer term. And from them coming to 0, I think we're going to see a lot of stimulus out there in the market, so first homeowner grants, the ability for people to be able to get finance, so on and so forth. There's going to be lots and lots of stimulus. So for me, I'm making sure that I've got buffers in place, hedges in place, things that I can do to actually minimize risk at my end on that front, and looking for the opportunities whilst we're going through these phases, as well as having the expectation that we're going to see interest rates go down over the medium term to longer term. So, you know, people say interest rates could go up to 10% again. If interest rates went up by 2%, where they're currently at 1.5%, if they go up to by 2% to 3.25, we're not going to see the property market fall over. We're going to see every part of the financial market fall apart due to businesses closing down, they can't afford their debt, so on and so forth. So just bear in mind that these actions cause ripple effects out in the marketplace and a greater sort of penetration out there. So that's where I come up with my own views. I can see some questions coming through. Should we fix interest rates? That's up for you to decide and for you to speak to, you know, finance strategists. For me, I look at it as I'm taking a bet with the bank. They've got lots of teams of people. They're trying to, you know, fix their monetary stuff in. You know, I personally have not fixed any rates, and I don't intend on it because I see them in the, you know, next few years coming down lower than where they are at the moment. That's obviously not financial advice, it's just my view. We're just here having a chat at the moment. And I see a question here about the Aussie dollar, will that die, or just US dollar? Every dollar is pegged to the US dollar. So it's like having a basket with rotten apples. They're all in the basket, they're all going to catch the same mold growing on them. So I think it's inevitable, as all currencies around the world are connected. Well, 99% of the currencies, they're all fiat currencies. So difference between a currency and a fiat currency is a promissory note which is backed by a network effect, whereas a real currency is backed by a tangible good which can be set with a tangible value attached to it. It used to be gold and silver, but it hasn't happened at least since 1971. So what will happen to the finance markets moving forward? Banks can play with interest rates. They have played with interest rates. I think the banks are protecting themselves by, you know, they need to be profitable for their shareholders. So a lot of people think, oh, I know the bank's going to do this, or the bank's going to do that. And the bank is a business. The bank is an entity, and you know, it needs to continually show profit. So if you look at the spread between what the RBA rate is and what the consumer rate is, it's much greater than what it ever was pre-GFC. So, for example, when the GFC hit, I think it was August 2007, we saw interest rates at 7.25% or 725 basis points at the RBA level, and they dropped 100 basis points, 25 basis points, 100 basis points, 100 basis points, 100 basis points. So the RBA rate was 7.25, went all the way to 3% within a period of 5 months. At that point, interest rates at the bank, from what I recall, I've got a pretty good memory, from what I recall, interest rates were around the 8.5, 8.65, 8.75%. That was around 2007. And interest rates went down in value, but the spread between the RBA and the banks was, you know, 1.5, 1.75%. If the spread was still that, we'd be seeing interest rates at 3%, 3.2%, so on and so forth. But now most interest rates are at 4.5%, 5%. I don't even know what the interest rates that I'm paying at the moment, personally. But yeah, it's much greater. It's like 2-3% spread over what the RBA is giving them out at. So the banks can play with the interest rates. I don't see them doing it anytime soon. They have pushed them up, but just be careful. Lending can get a lot tougher. If you think that you've seen a brunt of it already, it could get much, much tougher than what we've seen over the course of the last 24 months. So just bear that in mind. Don't have the expectation that, you know, this is what happened in the past. We're in a, you know, an uncharted time. We're in a point where, you know, anything could happen out there. Is it a scary thing? I don't believe so. I think it needs to be opportunistic. But, you know, just as I said beforehand, still got the flu. As I said beforehand, a a lot of people bought properties in 2016 expecting I can settle on it in 12 months, the loan won't be an issue, whatever the case may be. They're now in a position where no one's going to lend to them. They don't surface anywhere, and the banks have changed the rules, and it's all because of the pressures that they're copying from the governing bodies being APRA and so forth. Investors could get slammed. They are sort of getting slammed. They're getting picked on by the banks. The banks are trying to minimise their risk. The banks may not roll over interest-only loans, so this is really, really important for people to understand. Just remembering that what I'm saying here, I run a lot of property companies and all that sort of stuff. I'm always given information as it is. I've got no benefit. Most people out there in the marketplace don't share this information just due to the fact that they want to sell a property, they want to sell their wares, they want to sell their real estate agent wants to sell your property, a mortgage broker wants to sell your finance, all that sort of stuff. I just say it as it is. If you guys like doing business with me, happy to help out, but I think sharing my insights in the market is valuable, so I just say it as it is. So this is a very, very interesting one. What a lot of people have been working with for the last 5 years or so is interest only. Interest only lending means that you've got a 3-year period, a 5-year period, 10-year period where it's just interest only, and then after that, principal and interest kicks in when you have to pay down a little part of the loan. So your mortgage might be $220 per week now, where if it was principal and interest might be $250 or $260 or whatever the case may be. If it turns to principal and interest, that means that your cash flow expense is going out because you're having to pay down the loan. I'm personally happy with interest-only loans. If they turn to principal and interest, I just start paying off, because generally what's happened is my rents have gone up over the period of the last 5 years, and I push them up, say $10 this year, $10 next year, $10, $10, $10. They've gone up by $50. When it turns to principal and interest, I can start paying down the loans using the excess rent, and it's not affecting my own personal cash flow. But a lot of people go out there and think, well, it's just principal and interest, it'll be fine. What happens now if when you go into the marketplace, you try and refinance that interest-only period from 3 or 5 years for another 3 or 5 years, right? You want to not pay it for another 3 years. And the bank turns around to you and says, no, we're not going to refinance you because you don't service, or whatever the case may be. So, for example, a lot of people out there, due to their lending criteria, they were lending based on 5% interest rate. Now they're basing the serviceability calculators on 7% or 7.5% plus principal interest, and they're going, well, you don't service, so we're not going to give you a loan. You're lucky you got that loan, but we're going to do anything about that loan, but you don't service for us. So what happens if they start asking for more money, being the principal and interest? You can't refinance the properties. Those things there, we need to look out for and sort of need a budget. So budgeting throughout this time is very, very crucial and very important to ensure that you've got your house of cards in order. I think after the GFD, when we see the true effects of what's happening out there in the monetary systems globally, that things will become much easier, because the stimulus that comes after recessions, if you look at every time the property market has gone up in value, there's always been a significant event that's caused that to happen. Prices don't just rise for no reason. How have I been able to make so many calls over the last 15 years as an investor? Is understanding those markets. So I've talked about this one a couple of times, but sorry. Spoken about this one a couple of times where, for example, we've seen the Sydney property market increase over the course of the last decade. There's no denying that. We've seen Melbourne, we've seen the Eastern Seaboard increase. In mining areas, we've seen those areas decrease, right? Why did those mining areas go up? Why did the capital cities go up? What caused the capital cities each time over the last 2 decades or 3 decades to go up? the mining towns only went up because the actual commodity prices went up. So as the commodity prices went up, the demand to pull that stuff out of the ground, they built the infrastructure around it, the need for those dwellings to be there, and supply and demand kicked in. So that is what stimulated those sort of markets. If we're looking at tourism, I saw tourism laws change, and I saw that plane laws changed. Cairns, for example, got wiped off the face of the earth going back around 2010. And prices became very, very cheap there. If we look at the Sydney market, we had the 2000 boom, which was caused by first home immigrants, interest rates going down, and trying to stave off the dot-com bust. We then saw 2007 and 2008, the market, the first home immigrant increased dramatically, lending become easier again because there was a period where there was no construction happening because finance was too hard to obtain. So there is, lining in the silk lining in the problem that we're seeing is that rents will inevitably rise. The policies change and the markets react accordingly. A lot of overseas money came to Australia. A lot of liquidity came from overseas due to the fact that Sydney was seen, or that Australia was seen as a safe haven from a property perspective. So if you can forecast and see and analyze how these things will play, what things are happening out there, you can have your best foot forward to take advantage of those markets and the opportunities. But I do personally believe that the stimulus that will be involved in order to stop a GFC 2.0, or the GFD as I call it, will be so far more significant than what we ever saw back in 2008 and 2009, which will most likely set us up for the next phase in the cycle and prices increasing again. So I personally feel that we will see this tightening phase relax a lot, but it may take 12 months, may take 24, may take 36 months. Sorry guys for being sick. But I will report on that throughout my networks as it does happen, so you can have the best foot forward in being able to take advantage of these markets take off again. And liquidity is just drying up. So moving on to the next slide, I do realise I'm taking a little bit longer. What can you do to protect yourself from this? First and foremost, go and speak to your finance strategist, your mortgage broker, whatever. See what sort of access to the equity you can get. For me, my priority would be, if I was talking to my mother, she's too old to service given the new lending requirements. But if I was talking to someone I really, really care about, what would I be saying? Obviously not giving us financial advice, but be able to get access to your liquidity and park it in a safe place. So, if you go and get access to your equity now and prices are higher, the equity is more, whatever, you can't guarantee that if the market's going backwards. I'm pretty confident that those valuations and whatnot will not be in place moving forward. So getting access to equity now, so you've got capital and liquidity to go through this market, one for protection and two, so you can take advantage of the opportunities. As I said, not your financial advisor. This is just things talking aloud that you could possibly do. Prepare yourself, have a budget, understanding where all your numbers work, understanding how your cash flow works, understanding what you can do to improve your cash flow, understanding what sort of properties you need to buy in order to push yourself through the upcoming market and navigate through the finance market that we're seeing. Get the right team around you. Over the years, I've been referred to lots of people. I've had lots of different, people, whether it be staffing in my business, whether it be consultants to do certain things, whether it be from sort of, my personal property portfolio. People have changed over the years because either one, I've outgrown them, or two, it just wasn't feasible. So what's important is to understand that your team around you can take you to where you want to be. I haven't started off and kept the same mortgage broker throughout all the years because I've outgrown them. I haven't kept with the same lawyer over the years. I've outgrown them, and I've been fortunate enough to be able to find people that have been able to grow with me to get me to where I want to be. But make sure that the people that you're working with understand how finance works, or every aspect of your portfolio works. So do a tidy up of your portfolio. Try and trim the fat wherever you can. It may be that you could refinance to a better home loan rate at the moment. We can save some money or whatever. I normally look at the interest rate is probably the last thing I look at when getting finance. Is who I'm getting the finance through and what am I benefiting from refinancing. A couple of part of percent or a few basis points ain't going to change my life. You could move from one bank to another, save yourself 20 basis points, but with the next interest rate increase or decrease, or whatever the case may be out there, the bank may or may not pass it on. They may have their own independent changes. So you could just be chasing your tail throughout the property market. Try and focus on cutting off some fat in your budget and focus on putting more cash flow into your budget. So it might be reviewing of your rent, it might be looking at doing that little reno or whatever. There's lots of different things that you can do instead of just sitting on your hands and hoping that things are going to get better or whatever the case might be. So get your credit position assessed by experts. Make sure that you have a blueprint of where you're going to go with your portfolio and how you can keep continuing on your journey and kick ass throughout any sort of markets out there, and make sure that your house of cards are in order. Seeing lots of questions come through. I can't get to them all. Just looking here, we've been about an hour and a half at the moment. Talking about being raw and uncut sort of takes me to the final part of today's webinar. I've got something really exciting to talk to you guys about. Over the course of the last 15 years of investing, I've had lots of people ask me questions, want help, gauge help from all different angles. Ask me for mentoring. I've had people come to me and want to, pay me $5,000 to sit for an hour of my time, but I don't sell my time for money. I, do things because I want to do it. If I don't like doing it, I don't do it. That's where I wear my trusty thongs. What founder of a business or CEO or whatever you want to call me would walk into a business being like that. It's because I do it out of joy and passion. Yeah, I've had people, want to be a part of mentoring or have one-on-one coaching or whatever over the course of the last 15 years. I did a mentoring program as a one-off. I took 20 people on board going back around 2010, and I said I'd only do it as a one-off. I only ever did that for 12 months, took 20 people on board, made over a dozen millionaires in property within that 12 months, and never did it again. What I'm launching here at the moment is basically there's a lot of information that I've learned over the course of the last 15 years of being an active investor out there in all different markets. And over the course of the next 12 to 24 months, I want to be sharing throughout this GFD time and the changes in the financial markets. I want to be sharing my knowledge as to how you can navigate through them and be able to apply the same sort of strategies that I have to be able to exit the workforce during the GFC. So not just that, there's lots of different things that I will be covering off in the mentoring program. It will be a fortnightly webinar type interaction with 3 two-day live events where you'll be able to, see me in the room, talk to me. You'll be talking to my team over the course of the 12 months. Like they'll be interacting via, the education that I deliver you. So if we're doing something on tax or financial advising or building or finance or property management, I'll bring in my team to be able to share some knowledge as well over that period of time. And basically talking everything through from getting the portfolio started, financing through, financing your portfolio, negotiating properties, locating properties, how to renovate properties on the cheap, basically every aspect of property investing as it is, raw, uncut, delivering high quality content every fortnight for the next 12 months. The mentoring program will be $8,000 per year. But for the people that sign up from these webinars for a limited time as foundation members, it will be $3,000 for the year. If you think about what a personal trainer costs, I know that I pay for a good personal trainer nearly $100 per week. Here we are looking at $60 per week to be able to get candid advice from all different aspects to help you, sort of grow your knowledge, grow your wealth, and get yourself into a better position with your portfolio. So most people obviously go to university, spend, many tens of thousands, 50,000, 80,000 on a uni degree. If I can show you a few ways on how you can, save some money, make 50 grand, save 50 grand, maximize the sale price on a property, renovate a property cheaper, be able to add value, equity into your portfolio for a period of 12 months for $3,000, very, very cheap. I'm not going to sit here and sell it too much to you because I think it just says itself. So on that front, yeah, I'll tune out for the moment. I'm going to keep all the questions that are coming through. Lots and lots of questions have come through tonight. I'll go do some video series on that, and I'll be spitting them out over the course of the next week to 2 weeks on YouTube to help answer all the questions that you've got from this evening. So thanks a lot, guys. I'll catch up soon, and keep being awesome. And thanks for having me as a part of your evening viewing. I'll catch up soon.